Hey guys, we'll hop right into it here. Here are some updates I've seen across the market as of 9/7/2025. Here's an interesting graph. It shows return on invested capital by industry for the Russell 3000 from 1990 to 2021. Going left to right, it shows the highest median return indicated by those blue dots. Surprisingly enough, with the highest median industry return going left to right being tobacco, household products, and leisure and equipment and products, leading the pack here. The most volatile industries, the most swings with the highs to the upside as well as the downside. You can see with, the tails above and below there, that zero line being biotech and internet software services slash tech services. Here's another cool graphic. It basically just shows the cost of timing the market. It's pretty cool if you just look at this line with the 10K dotted line going across to this side. It shows, starting from left to right, if you're invested all days, your return would be 64 grand. But if you only missed the 10 best days in the market, 7 of the 10 best days took place in bear markets, as signaled by the second line in the graph. You'd only have 29 grand, almost less than half. Missing the 20 best days, you'd be down to 17 grand. It really just shows, you can't really time the market. A lot of these returns aren't smoothed out over time. They're very lumpy and come in randomness. And rather than time in the market, just spend time trying to time the market, spend time in the market. Here's another cool graphic I saw going around was the average price of electricity, per kilowatt per hour here in the U.S. city, the average since 1980. And it's just interesting to see the recent surge in price here. I thought it was worth noting amongst, the AI race and Bitcoin, amongst other drivers. The U.S. economy has barely added any jobs in the past 3 months. You can see in the bottom right here of the first picture that there were 22,000 jobs added in August and 79,000 added here in July, and there were actually 13,000 jobs lost in July and June. They usually revise these downward a couple of weeks or so later, so I think it may even be worse than this in weeks to come. The next picture to the right shows the biggest projected job declines in the U.S. by industry. Number one being cashiers, number two, customer service reps, and number three, office clerks. Number four is fast food cooks. Here's another interesting graph I saw. There's been a large increase in administrators relative to physicians. You can see this separation since 1990 and then the, extreme spike onward. And, relatively speaking, the physicians have stayed relatively flat. The administrators spiked. So this could be a big significant opportunity for AI to replace admins in healthcare, in my opinion, in the years to come. Rounding out some more headlines here. I'm sure you've all heard about, alcohol sales being down, Gen Z not drinking, kind of, losing its traction for the first time ever. Just to show you here, the news article here that alcohol consumption in the U.S. has fallen to a record low per Bloomberg. Keep going on. I guess times are changing here. No more alcohol drinking, no more cable TV. Another news recent headline here, just streaming reaches historic TV milestone, eclipses the combined broadcast and cable viewing for the first time ever in history. And just another cool headline here, AI automation cuts entry-level tech jobs by 50% since 2019. Seems that AI steadily seems to be taking more and more, and the fear keeps settling in on taking and cutting entry-level jobs here. On to the precious metals, looking at gold and silver. Silver here, silver's been breaking through 45 years of resistance recently, finally, if you've ever watched silver. Silver returns over the past 5 years compared to the S&P 500. You can see the silver in gray or silver and the S&P 500 in blue. And you can see that, the silver has out-returned the S&P 500, not for dividends. And gold really hasn't seen as much resistance as silver. You can look back, further the longer chart for silver, but Gold has had a more smoother run up in here. Gold return over the past 5 years, just like silver, has been gold in yellow and the S&P 500 in blue. And gold has been outperforming stocks before dividend. So continuing on about gold, the global international reserves of gold are at an all-time high. As you can see in the graph, the shaded in gold area here represents the gold holdings, and in the bottom right, you can see the increase as of Q1 2025. And then last slide here about gold and silver. It's just the recent movements there. And precious metals have been pretty impressive relative to S&P 500 and any other index. The foreign central banks here are holding more gold than treasuries for the first time ever since 1996. All right, enough about gold and silver. What about the broader market? I see a lot of people asking, is it overvalued, undervalued? You know, People looking at the Buffett indicator, I kind of think it's outdated in my opinion for a couple reasons. Some people look at the price to earnings multiple of the market. In my opinion, I think it's more appropriate to look at the PEG ratio here, PEG of the S&P 500, which takes into account, the expected growth along with the price to earnings ratio. Yes, a lot of things do have to play out in terms of growth, for this to actually make sense. But assuming the growth does pan out, the market is well within normal and healthy historical ranges, as you can see in the graph. So what are people buying? Where's the big money going? Looking at the recent 13 Fs, the big money as of Q2 2025 by market value has been shifting towards United Healthcare. I'm sure all of you have heard, Warren Buffett has taken a big stake in it. Then we have Amazon, Nvidia, Berkshire, Microsoft, and continuing down the list, you can read the rest. And it's interesting to track what the big guys do and do your own analysis and pick from there.